Hello value investors, thank you for joining me. Today I want to talk about Coupa. So Coupa just released their Q1 2022 results. So we're going to talk about why the stock sold off. We're going to talk about its revenue growth rates. We're going to talk about one of the blemishes that I see in its results. Then we're going to bring that all together and talk about its valuation. Before we get started, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why, and stocks that I am particularly bullish on right now. So let's get started. So Coupa is a procurement website, a procurement platform, and it's well positioned because it's really a very simple to use platform and has a real feel like enterprise platform, like a consumer platform for enterprises. So it's something that you can really break down the silos in the management team when you come into source supply chain stuff. So it's quite compelling because as enterprises become more and more fragmented, this is something that is cloud native and it could really take off. And that has been the thesis in the background for many of these SaaS stocks. If it's cloud enabled and if it's part of increasing productivity for enterprises. So in 2020, last year, this type of narrative just took off and investors were just willing to buy this type of stock. Now in 2021, things have kind of moved around slightly, and that's why the stock is down, and over the last 12 months is practically unchanged. So let's dig in a bit further here. So the revenue growth rates for this quarter, Q1 2022, were very good, 40% year-over-year growth. The problem is that the guidance going for the Q2 is kind of a 25% or 29% at the high end, probably not quite enough for high growth narrative stock. You know, you kind of really want it to be nudging above that 30%, because anything that comes below that 30% is like a mental hurdle, and investors start thinking, oh, this thing is maturing. Even if it's not, investors start thinking like that. So you don't really want to be putting out guidance, even if you're trying to be conservative, that's below 30%. Anyway, that's what they did, and that's why the stock is down. So another thing that I kind of looked at, so even if you look at the non-GAAP EPS number, they've added back, as everyone does, a lot of stuff, including the debt issuance costs. Now, even with all that added back, the company was profitable non-GAAP metric at 20 cents last year per share, and this year it's 7 cents. So it's gone from 20 to 7. So it's actually, as the revenue growth rates continue to increase, it actually is becoming less profitable. So obviously investors, you know, it's already a turbulent market as it is right now, so investors are kind of thinking to themselves, okay, growth rates decelerating, EPS numbers are not really stacking up. This is one of the few SaaS companies that I know that actually has approximately 1 billion, 1.1 more or less, net debt position, so on its balance sheet. So you have like quite a lot of leverage, you have profitability going in the wrong way, you have revenue growth rates decelerating. Is this really going to be the kind of stock that investors are going to be willing to pay more than 27 times forward sales? Well, it turns out that they didn't. So now, as I'm writing this, so the stock is approximately 24 times forward sales, kind of taking a bit of a knockback. That's not to say that there are not more expensive SaaS names. For example, CrowdStrike is approximately 36 times forward sales. Datadog is another one that's an outlier, that's approximately 31 times forward sales. Having said that, I wouldn't really compare this with SAP, because SAP last October had that issue and it hit a rough patch, so that's already really kind of taken its toll on the stock, and the stock hasn't quite recovered. So I think it's not a direct pair, but I think something like ServiceNow could be something like that. It's in ServiceNow as an workflow automation platform for enterprises, so it could be something kind of in the ballpark that could be used as a comparable. But in the case of ServiceNow, so although it's very much similar in terms of revenue growth rates, it's priced at 17 times forward sales. But the big difference is the ServiceNow has 30% free cash flow margin, whereas Coupa, as we just discussed, is not going anywhere near that. So just to bring it all together, the stock is kind of richly priced. It's not really, the results were not terrible, but I don't know if investors are really willing to pay a large multiple for it. It could recover. but I think that there are probably better stocks out there. So don't forget to check out my marketplace. I'll tell you some of the good stocks that I own, and I'll see you next time. Bye.